aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
A lot's happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe its central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. A lot of economic data coming out this week. We got CPI tomorrow, PPI the following day. Lots of data points for our Federal Reserve to parse through. We're going to check in with Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence, get a sense of what he's looking for. And then we're going to talk ETFs with David Schassler, Portfolio Manager and Head of Quantitative Investment Solutions at Van Eck. Always a good discussion. Allison Williams will join us here in studio. She's from Bloomberg Intelligence. She's going to help us preview the bank earnings. We got three big banks reporting Friday, so we want to get ahead of that. But right now, let's kick things off with Nathan Hager down in Washington, D.C.
Yeah, with all that happening later on this week, Paul, we might be seeing a little bit of trepidation from investors before we get that inflation data tomorrow and the kickoff of earnings season. We're not seeing a whole lot of movement in the broader indexes, but we did hear this week from no less than 3 Fed speakers just yesterday, in fact, arguing for higher interest rates to bring down inflation. Cameron Dawson, Chief Investment Officer at New Edge Wealth, says the question for investors now is what the longer in higher for longer is going to mean.
The Fed and the market have a lot of rate cuts priced into 2024. And that's the big question as we roll into that next year, which is that do we get those cuts or does the Fed stay in this restrictive territory for some time? If it's the latter, then we think that there could be upward pressure still on yields as those cuts get priced out. And then it could have implications on equity markets when we think about valuations really trading at the high end of historical ranges.
But looking at the equity market right now, not seeing a whole lot of movement. We check the markets for you all day long on Bloomberg, and right now the S&P 500 is up 5 points, 0.1%. 4414 is the S&P level. The Dow Jones Industrial Average up 91 points, a 0.3% gain, 34,035. The Nasdaq's moving a little bit lower, down 11 points, almost 0.1% at 13,673. 10-year Treasury's little change now. The yield 3.99%. 2-year yield is 4.88%. NYMEX crude's catching a bit, up 1.5% right now, up $1.05, $74.03 a barrel. COMEX gold is up 0.4%, up $8.20 at $19.39.20 an ounce. The euro at 1.0985 against the dollar. British pound 1.2902. The yen is at 140.81. The share of small businesses raising prices fell to its lowest level last month in more than 2 years. The latest National Federation of Independent Business report says 29% of small businesses reported higher prices in June compared to 3 months earlier. That could be another potential disinflationary force in the economy. That's a Bloomberg Business Flash. Bloomberg Markets is on with Paul Sweeney and Jess Menton, right?
Yes, it is. Thanks, Nathan. We appreciate it. So Jess Minton and Paul Sweeney here in the Interactive Brokers studio. And we have a busy week, especially because we still have CPI on Wednesday, followed by producer prices on Thursday. And then, of course, we'll have the bulk and the kickoff to earnings season with JP Morgan and other big banks reporting on Friday. But before we get there, I want to bring in Alice Andre for our market drivers report. Alice, thank you so much for joining us. You're a Bloomberg Forex reporter here. What are you watching heading into a lot of these reports this week?
Well, I'm really just focused on the consumer, and I'm still pretty high on the consumer. This is something I talked to you guys about a month ago. The trends that I'm seeing is that you just kind of have to look at the economic data. The labor market is very strong. People are working, and inflation is showing signs of coming down. And also the things that impact the consumer, kind of on the psychology side, are these inflation expectations. And yesterday we got a report from the New York Fed that showed that 1 year ahead inflation expectations fell to 3.83% from 4.07. I think that that's just a lot more palatable for the consumer. Market psychology has so much to do with consumer spending. And when consumers think that inflation is going up, they're definitely pulling back on their pocketbooks. And so with inflation expectations coming down and possibly the inflation data this week showing a little bit of a pullback, I think that will fuel consumer spending, especially since the labor market remains so strong.
What do you think the market's telling us about just kind of, I don't know, I guess, the sense of inflation out there? It seems like, as you mentioned, it's coming down, but the consumer is still pretty strong. So is recession off the table, Alice? Allison, do you think, is recession off the table? I know that's been an issue.
I do. I think that the Fed has been doing a phenomenal job of managing this inflation. I mean, it's come down quite a bit, and they're still keeping the labor market strong. I just think that the consumer is just going to be fine going into the fall. And one of the things that I really like to lean on is some of these purchasing managers reports, all these big Fed reports, and something that I've had a thesis on since probably January is just that the second half of the year is going to be very strong. I think it's very clear that right now we're in an inventory kind of retooling. We're still drawing down a lot of inventories. Just keep in mind that after COVID, people were just buying and buying and buying. Companies were stocking and stocking to keep up with this consumer demand, and now we're in a situation where we're a little bit over inventoried. And this is something I really keep a close eye on. And inventories are, even though they've come down quite a bit, they're still a little bit bloated. And we need to have a turn of a season and a turn of new products to bring in new inventory. And I think that that's what's going to happen once you start maybe in about the second half of the third quarter and into the fourth quarter. And I think that the need to rebuild and restock is really going to promote growth. And if you can keep the labor market strong and inflation still coming down, which the Fed will, I think that that's going to promote some consumer spending. I think that will be really a tremendous boost for stocks.
And Alice, we still have a while before we'll hear from the big retailers, whether we're thinking about Walmart or Macy's, because obviously we're going to start off with the big banks, and then we'll have pharma, and then big technology companies. What kind of indicators are you using to gauge when you're looking at what you're talking about with this sort of inventory glut there?
So, a lot of it is observational. If you go into stores and you see big racks of clearance, or you see, just tons of this or that, I'm seeing this everywhere. I go to certain stores and I see just tons of things lined up, and I'm thinking to myself, at this time in the season, these things should be gone. And so to me, that really helps me give some concrete evidence that we are in an inventory correction. So as they clear out these items, you're going to see a period of slower growth. But everything that I see in a lot of these Fed surveys and the PMI surveys is that people are hoarding their labor market. Mm-hmm. They're ready for a strong second half. and they're ready to retool and build product.
Hey, Alice, you're one of our FX experts here. So while we've got you, I'm looking at the U.S. dollar. It's off about 10% from that high back in, I don't know, September, October. Can you tell us what's going on there?
Yeah, I mean, I think that that's just a function of what we've been talking about here, that, we're seeing a little bit of slower growth. And I think that the dollar will probably repair itself a little bit coming into like I said, the latter half of the third quarter and into the fourth quarter. I mean, I don't really think that the dollar can deny if the consumer is going to stay strong and continue to spend here in the U.S.
Something I was curious about too when we're talking about the dollar is when you look at what's happening with some of these hedge funds, they're basically shorting the dollar, thinking that when you're thinking about the correlation and the Fed being close to being done with its tightening cycle, starting to short that. What is that telling us there, and what could that mean for the trajectory of the dollar moving forward?
Well, so what's really happening is if you look at a lot of emerging market currencies, I mean, they've been the stars, right? So people are shorting the dollar to be able to buy things like Mexico, the Brazilian real, and stuff like that, and so they're picking up their profitability there. I think that once that turns around and the U.S. economy does better, we will see a reversal of that trade with the dollar going up, and some of those emerging markets that kind of got a little bit lofty will probably be coming down.
So, Alice, I mean, we feel like the next meeting will be a move up higher by the Fed. What's the market telling us, from your perspective, about the following meeting? Is there another one out there?
Yeah. So, obviously, we're pricing in a really high probability. I think it's about 90%. The market is not really ready to price in any further hikes down the road. I mean, I think we're about 50% for the September meeting, but 50% isn't 90%. So, I think that the big thing is going to be what's the tone of Powell at his press conference, and then we're going to have a couple sets of data that comes out and that will verify in August. You'll get another 2 payroll reports and another 2 CPI reports, so in August and September, before that September meeting. But the tone of Powell at the end of the month will be very critical, and then what Fed speakers have to say after that. I mean, but what we've heard from the Fed this week is it's full steam ahead with a few more rate hikes.
And with CPI coming out tomorrow, if you look at these projections, it's supposed to be around 3.1% when you're looking at year over year for CPI, and this would be the anniversary from last June's data when CPI peaked actually just over 9%, so cut more than half in just a year's period. Do you think this one report is enough to sway the Fed either way at its next meeting later this month, when we don't have a batch of a lot of other inflation metrics that are left before that?
The market is, like I said, pricing in about a 90% chance of a hike at the end of this month. And so I think that it's pretty set in stone. I think that CPI would have to be way out of line to change the Fed's thinking. I also think that one data indicator typically doesn't make a trend, but we have seen a trend lower in inflation. But if this inflation report tomorrow was way higher than we ever expected, I don't really think that would change the trajectory of things. I think that what we're seeing is just an overall trend of slightly lower inflation with some sticky stuff in there. And that's the other part. You probably want to keep an eye on that core inflation report. That will probably be the one thing that investors focus on a lot.
So, Alice, you're in Chicago, right?
Yes.
So you're enjoying your, I guess, 3 weeks of summer before the winter comes back to you guys? I mean,
yes, but it's been really wonderful here, actually. It's just been perfect.
Good. So so the skies have cleared up. There's no more smoke from Canada?
No more raining out NASCAR. It's been really
Okay. All right, Alice, thank you so much for joining us. Alice Andre, she's Bloomberg's FX reporter. She is based in Chicago, giving us kind of the lowdown here of this market. So, again, I mean, the busy Calendar coming up here for Sunday's Eco. If you just typed in Eco Go, there's a lot going on. So let's check in with somebody who's going to be watching this very, very closely. He's got models all over the place. He knows where the money's going, where the rates are going. That would be Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence. So Ira, a big week of, or a big couple of days coming up of some economic data from on the inflation front. What are you looking at? Uh-oh. I don't know if we have Ira, so he might have some technical problems.
I'm wondering
he's down in Princeton. I mean, it's a long way from New York.
I'm wondering, though, because we can't see him since he's on the phone, if he has his soccer suspenders on.
Yeah, right, exactly. Exactly.
Always looking for that.
But the CPI, I'm looking at the CPI, it's, the headline year over year is 3.1%. That's important because what was it last month? 4%.
Yeah.
So that big trending line, that's kind of the headline. And then, of course, if you back out food and energy, it's 5% is the outlook, and that's down again from 5.3% the prior month. So, the story is and has been inflation is coming down.
It is.
Is it coming down as fast as maybe the Fed would like? That's the question.
And I'm glad you said that because I wrote a story about it, but we can get to that later.
Oh, I bet you we will get to that later. All right, let's get to Ira Jersey here. So, Ira, again, Jess and I were just talking about a lot of economic data this week. What are you going to be looking at?
Well, obviously, it's a CPI report tomorrow. I mean, that's the the granddaddy of all the reports that are coming out prior to the next Fed meeting. So I don't think it's going to change the Federal Reserve stance, and I suspect that the market could wind up being pretty aggressive depending on what happens. So if you get a lower than expected number, like a month-on-month number of 0.1, like we had last month for headline CPI, you can actually see 5-year Treasuries rally quite a lot, so lower yields in that belly of the curve as we kind of price earlier rate cuts and maybe not that second hike that some people at the Fed are thinking might happen later this year.
Ira, one of the key takeaways from last month's panel that did feature the world's top central bankers, obviously including Fed Chair Jay Powell, was that he said core inflation would get back to 2% in 2025 and still reiterated that we were a really long way to go until then. Exactly. And so, I mean, what is the bond market telling us? And was there any sort of repricing after he was talking about that, and as well as other central bankers?
Yeah, there was a repricing in the market, particularly in the front end when you saw 2-year yields, basically rose 50 basis points over a couple of weeks after the Fed meeting, and then you had that panel discussion, like you mentioned, in Portugal. So one of the big takeaways from the panel, I think, was just how focused on inflation every central bank is around the world. Everyone wants it. Now, granted, outside of the Fed, most central banks have a price stability mandate only. They don't have this price stability and full employment mandate that the Federal Reserve has. So because the ECB, the Bank of England, and the Bank of Japan all have a single mandate, they have to be hyper-focused on inflation, whereas the Fed does kind of have a choice. Now, right now, and a lot of it's obvious that there really is only a single mandate because the job market continues to be so strong, regardless of some of the internals where some sectors are losing jobs, but a lot more sectors are still gaining jobs, and wages are still growing at a reasonable clip. And that's what you saw on Friday, in Friday's data, was that there's still a concern that with job market being as strong as it is, that you'll wind up with those core inflation, and particularly services are going to wind up having much higher inflation than the Fed would like.
Ira, just about 30 seconds left. Is QT still a thing? Is the Fed still tightening?
Yeah, so the Fed's going to continue to run off its balance sheet probably until the beginning of next year. Our view is, and this is a real concern, is that we'll reach this reserve tipping point of around $2.5 trillion in reserves in February or March of next year. And once that happens, the Fed is going to have to stop running off its balance sheet. Doesn't necessarily mean that they're going to be doing quantitative easing, but for financial market function, they're going to have to stop reducing its balance sheet.
All right, I think we saw a little bit of that a couple of years ago. Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence, calling us on the phone, giving us a little bit of a preview of kind of what we should be looking for tomorrow with the CPI data, and then the following day with the PPI data. This is going to be key for the Federal Reserve, which has been very consistent, just saying our job number one continues to be fighting inflation.
Right, and it was in fall of 2018 when QT,
yes,
the balance sheet,
right,
really rattled the market.
Yep. So hopefully the Fed is going to try to avoid that again here. S&P 500 pretty much unchanged. I felt like I said that a million times yesterday. Same for today. This is Bloomberg. Let's get some company news right now. Steve Rappaport.
Paul, shares of Rivian opened lower after the EV maker racked up gains for 9 consecutive sessions. Bloomberg's Charlie Pellet reports.
It marks the company's longest ever winning streak. During that period, Rivian rose 90% as it said it built more battery electric vehicles last quarter than Wall Street had anticipated. Last week, the company said it started shipping hundreds of vehicles to Europe for Amazon. Still, Rivian has a long way to go. Tesla built 34 vehicles for every one that Rivian assembled last quarter.
Thanks, Charlie. PGA Tour officials are on Capitol Hill this hour defending their plan to join forces with DP World Tour and Saudi-backed Live Golf. More from Bloomberg's Malathi Nayak.
Having these three entities come together and form like a giant monopoly is something that could potentially be a cause of concern, and looks like it's already raising red flag when it comes to regulators. And we've been reporting that there have been some concerns already, and regulators will potentially be looking at this more closely. Already the DOJ is examining the PGA's policies. They started an investigation last year.
Thanks, Malathi. Amazon is dangling an invite-only promotion designed to give customers a better shot at scoring the big Prime Day discounts they want. Shoppers request an invite for discounted items they see. They'll get an email if the deal is still available, along with a unique link to buy the product. Amazon Prime Day sale runs through tomorrow. And those are the companies...
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 10:21 on Wall Street. I'm Nathan Hager. We check the markets for you all day long here on Bloomberg. Right now, there's not much to tell. Investors are kind of waiting to place major bets before the next round of inflation data comes out tomorrow. Right now, the S&P 500 is higher by 6 points, or about 0.1%. The Dow is up 0.3%, a gain of 94 points. The NASDAQ is little changed, down 2 points. 10-year Treasury's up 2/32, yield 3.98%. The 2-year yield is at 4.87%. 8 of the 11 main industry groups on the S&P 500 are in the green, led by energy and financials. Information technology is the biggest laggard. We got a report from OPEC this morning that oil export revenues hit a near decade high last year, and right now NYMEX crude is higher by 1.3%, or 95 cents, $73.94 per barrel. COMEX gold is up about 0.5%, up $8.80 at $19.3970 an ounce. The euro is at 1.0988 against the dollar. The yen 140.81. Watching Amazon shares are higher by 1.2% after a 2% slide yesterday, with the annual Prime Day sale underway this year with a invite-only promotion. And Salesforce is raising prices for the first time in 7 years after introducing artificial intelligence features. Base prices across the major product lines are going to go up about 9% next month. Salesforce is higher by 2.4%. That's a Bloomberg Business Flash. Bloomberg Markets continues with Paul Sweeney and Jess Menton.
All right, Nathan Hager, thank you so much. We appreciate that. Jess Menton sitting in today. Good to see you again.
I know, a happy Prime Day.
Yeah, Prime Day, which we all decided earlier today, it's just not a thing. I'm not doing it. I mean,
it
like
hasn't
every day's
really
Prime Day for people.
It definitely is, and we were actually doing some analysis on our stocks team where the last 4 years hasn't really moved the stock the way it typically had in prior years leading up to the pandemic.
Exactly, but we talked to Poonam Goyal at Bloomberg Intelligence. He said it's still going to be like 8% of this quarter's sales will be in a couple of days, so go figure. We'll see. Maybe I'll go out and buy something. Let's talk commodities. I'm looking at the Bloomberg Commodity Index.
BCOM.
Exactly, and from its recent high back in August, September of last year, it's down about almost 20%, so there's disinflation for you, I guess. But we got somebody in our studio here who knows a lot more than we do. David Schassler, Portfolio Manager and Head of Quantitative Investment Solutions at VanEck, joins us here in our Bloomberg Interactive Broker studio. David, talk to us how you guys at VanEck, how you guys trade, invest in commodities.
Sure. So we manage a commodity fund. The ticker's PIT, P-I-T. It's a throwback to the old commodity pits. Really what we do, it's a quantitative approach. So we're looking at a few different things. The first, we're looking at what is the structure of the curve. So are we in backwardation or contango? If we're in backwardation, it's an implication that there's some likely supply issues, right? A bullish sign. So that's something that we watch very closely. Secondarily, what we're doing is we're looking at prices and seeing, are these commodities well behaved or not? Clearly, natural gas has not been. We've been really significantly underweighted for a very long time now. And then the third, mean reversion. Commodities are super cool in the sense of they may not have the most attractive return stream, but they're always zigging and zagging.
Right.
And if you watch those zig and zags relative to each other, there's usually an opportunity. So we will look for mean reversion opportunities within there. So it's a very active strategy, and that's what we do.
So how are you advising clients to position at this point?
Within commodities or from an overall asset allocation
Let's start with
perspective?
commodities first.
Within commodities right now, we are bullish on energy. We have around a 50% allocation, 50% allocation to commodities, significantly higher than what you referenced before with the Bloomberg Commodity Index. We're bullish on oil, right? We've got a big CPI report coming out tomorrow. Don't have a big view on that, but if you look at the CPI trends, inflation's falling largely because energy prices are falling. We don't think that that trend continues. In fact, we're obviously betting in the opposite direction. A lot of those issues we think are behind us. Lower prices, softer prices are discouraging production, right? Saudi Arabia reducing production, eating into supply. Obviously, the SPR stuff largely behind us. We think oil prices firm up here, go higher. Clearly, we're betting on that.
So then the production issues would be the catalyst to moving energy prices.
Yeah, so hate to be bearish on the economy, but we are.
Okay.
But there's a relatively inelasticity of demand when it comes to energy prices, when it comes to oil. So we think we can see a softening in demand modestly. We think that the supply side is where the juice is in this story, and we think that that's what firms up prices and eventually drives them higher as we move later in the year.
And now the contra call to this is Bloomberg Intelligence Mike McGlone, our commodity strategist, Miami Mike, he says oil goes to 50 before it goes to 100. And and his thing is, and I won't speak for him, but anyway. So, and I guess the bearish call is just demand, that the demand curve is outweighing the supply curve here. Is that a concern of you, that demand out there, whether it's Russia not being as strong as we thought, whether it's being the continued tensions in Ukraine or whatever, maybe a recession in the U.S. How do you think about the demand side of the energy space?
Demand softening continues to soften because we do have a bearish view on the economy. Okay. That's what's likely going to happen when the Fed takes the juice bowl away. So we think that that's going to continue, but it's a supply side story. So we think that the supply side is going to cause an imbalance, sends oil prices higher. Now, if we're talking 2 to 3 months out, he may be right, we may be right. But if we're talking 6, 12 months out, we think that we're right.
So we talked about positioning specifically in the commodity space. What about more broadly?
Our view, broadly speaking, is that investors should have an allocation of 10 to 15% to assets with scarcity. Okay. We're talking about commodities. We're talking about natural resource equities. We're talking about gold bullion, gold equities. These are the assets that have historically performed the best during periods of high inflation. Now, quick preview on our view on inflation. This time is not different, meaning inflation doesn't happen often, but when it does happen, it sticks around for an extended period of time. We think that that's what happens. CPI, again, being pulled back because of energy prices, we think that reverses. With periods of inflation, pockets of inflation, disinflationary pockets, pockets of inflation. It comes in waves. We are right now in a disinflationary wave. We've said it for a long time. Once you get into one of these disinflationary waves, everybody's going to come out of the closet again and say, listen, we knew that inflation wasn't going to happen. It was only temporary. That crowd's going to come back. They're going to be really, really loud. We think that they get tricked again. Inflation continues. And we end up with an average level of inflation significantly above 2%. During these regimes, you want to own assets with scarcity. I look at the S&P 500 right now, I get very nervous. I see a rich index, I see an imbalance index. I see an index that is dominated by the 5 biggest technology companies that have negative earnings yield relative to short-term treasuries. Then I look over at energy stocks. I see positive earnings yields. I look over at diversified miners. I see positive earnings yields. I sit there, I scratch my head and say, how can you be comfortable with the S&P 500 when you see such attractive opportunities, specifically within energy, most attractive segment of the market right now, in our opinion?
Sugar. I like sugar.
We've been bullish sugar for a long time now.
How do you? What's the call on sugar?
So we've been bullish on it. We've taken profits on it. We're likely going to continue to do so. That's a supply-demand imbalance story. We picked that up based off our technicals. We're still bullish on it. We maintain our bullish position on it. It's just a situation when you look at the commodity complex and you look at energy, and we see probably better opportunities there going forward than with sugar, but we've done well with it.
Sugar is up 17% year to date. Is it? So if you invest in sugar, you just think the demand's going to be higher than the supply, right? I mean, it's just a commodity. Or is that kind of how you go about it?
That's the case for all commodities, yes.
That's right. So you just think that demand is higher than the supply. So has it been a supply issue that you guys got right, or was it the demand side?
It has been a supply issue that we got right. Why did we get it right, though? We got it right because we read the tea leaves from the technicals of the market. So again, what are our 3 pillars of investing? We look at the structure of the futures curve. We look at the price of it. It had an attractive return profile. And that's why we were biased towards it. Now, why was all that happening? Because of the weather situations, because of what happened on the underlying supply side of sugar, and that was the catalyst.
Where do you grow? Where's sugar grown? Where do we get sugar?
Sugar's India's big exporter. Sugar's across the board.
Is it? Okay. Yeah. I didn't know if it was like some part of the world that was having a drought or this or that.
Yeah. So we read the tea leaves from the technicals. The technicals are driven from the supply-demand imbalances.
Yep.
But we are not fundamental analysts. What we are doing is we are looking at the structure of the curve. We're looking at the supply-demand imbalances.
What about infrastructure? Because I know that's another big part when you're looking at the allocation within your ETF.
Infrastructure is really cool in the sense of if you are bearish on the economy and you want to protect profit margins, think of companies that have effectively, you can almost think about it as contract pricing. Think of toll roads, airports, heliports. These are businesses that are really insulated from inflation so they can maintain profit margins, and they are very defensive if we roll into a recession, which unfortunately is likely to happen given where we are, right? So when we think about the portfolio, right now we're invested in infrastructure through our inflation allocation ETF, ticker RAX, RAAX. It's around a 16% allocation. If the economy has a crash landing, obviously commodities are going to be vulnerable there. And we look at the portfolio and say, what should do well? Infrastructure should do very well in that environment. That's why it's there. It's there as a diversifier. It's there to maintain profit margins if inflation continues, which we expect.
Man, I learned a lot today.
So did I. I love this sugar.
We'll get this guy back here.
Yeah.
David Schassler, portfolio manager and head of quantitative investment solutions at Van Eck, doing commodities, lots of symbols out there to follow some of those. Now, are those, David, just real quick, are those funds or are those ETFs?
ETFs.
ETFs, okay. God forbid anybody is in the mutual fund business anymore. It's all ETFs.
Right, it definitely is.
That's what the kids are doing. I get it. The days of me going up to Boston and seeing all the big mutual funds, I think that's a thing of the past. David Schassler, thanks so much for joining us. S&P 500 up 0.1%. This is Bloomberg. Right now, we're going to head down to Washington, D.C. We're going to get world and national news. We're going to do that with Amy Mars.
All right, thank you, Paul. Turkey has agreed to support Sweden's NATO bid, a major breakthrough for NATO to strengthen its defenses after Russia's invasion of Ukraine. On the first day of the summit, National Security Advisor Jake Sullivan says if Russian President Vladimir Putin thought the alliance was going to cave, he was wrong.
Putin has been counting on the West to crack, NATO to crack, the Transatlantic Alliance to crack. He has been disappointed at every turn. Vilnius will very much disappoint him.
National Security Advisor Jake Sullivan. This is a bipartisan group of senators is in Lithuania to attend that NATO summit. Senator Dick Durbin of Illinois says the alliance is stronger and more unified since Russia invaded Ukraine.
His invasion of Ukraine has revitalized the NATO effort to protect democracy-loving nations from invaders and war criminals like him.
Illinois Senator Dick Durbin. Meanwhile, Ukrainian President Volodymyr Zelensky has scolded NATO for not setting a clear timeline on his country's bid to join. President Biden has said that Ukraine really shouldn't join yet. NATO Chief John Stoltenberg has said he'll push for a fast-track process. 2 Amtrak cars have derailed at Union Station in Washington, D.C. Firefighters are on board those trains. They're upright, but they're stuck in a tunnel just before the station there. One passenger is being evaluated by emergency crews, but there are no other injuries reported. Trains between D.C. and Virginia are disrupted now because that train is blocking the tracks. Justices teach when the Supreme Court is not in session. It can double as an all-expenses-paid trip and more. Records obtained by the Associated Press show the Supreme Court justices have attended publicly funded events at colleges and universities, allowing the schools to put the justices in rooms with influential donors. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris. This is Bloomberg.
dapat tahu daripada Facebook and Irene sangat gembira dapat hadir hari ini. Jangan
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 10:40 on Wall Street. I'm Nathan Hager. We check the markets for you all day long here on Bloomberg. We're starting to see a little bit of a lift to the markets, but not a major move here. A lot of traders are sitting on their hands ahead of tomorrow's inflation data, but right now the S&P 500 is higher by 8 points, 0.2% gain, 4418 now the S&P level. The Dow is up 106 points, or 0.3% at 34,051. The Nasdaq is moving just a touch higher, up 18 points, or 0.1%, 13,704. The 10-year Treasury is up 3/30 seconds. The yield there 3.98%, so trading around 4%. But could benchmark treasuries go higher if the Fed signals or continues to signal more rate hikes? Kathy Jones is chief fixed income strategist at Charles Schwab.
We think there's a pretty strong likelihood that 4.25 to 4 1/3 that we got last October is the peak of the cycle, but really can't rule out the 10s going back up and testing these higher levels because the Fed continues to hike.
And again, the 10-year right now is at 3.98%. The 2-year yield 4.88. NYMEX crude's up 1.5%, up $1.09, $74.08 a barrel. COMEX gold is up 0.4%, or $7.70 at $1938.70 per ounce. The euro 1.0989 against the dollar. The yen is at 140.72. Bitcoin's down 0.9%, trading around 30,500. Bank of America is going to pay $250 million for improperly charging fees and mismanaging accounts and rewards. Consumer Financial Protection Bureau says it is fining B of A for, quote, systematically double dipping on fees to customers with insufficient funds. Bank of America shares right now are higher by about 0.5%. That's a Bloomberg Business Flash. Bloomberg Markets continues here with Paul Sweeney and Jess Menton.
Thank you, Nathan. We appreciate it. Jess Menton and Paul Sweeney here in the Bloomberg Interactive Brokers Studio. And Paul, as you know, we've been discussing so much about those big banks coming up, reporting earnings, but also when it comes to the Fed's Vice Chair for Supervision, Michael Barr, is proposing those big bank regulation changes where what would happen with banks with at least $100 billion in assets could face higher capital limits. So who better to speak with us about both of those two topics? And Allison Williams, Senior Global Banks and Asset Manager Analyst with Bloomberg Intelligence, who's here in studio with us. So I'll start off, Allison, when it comes to these changes that Michael Barr is proposing. Can you walk us through what that really means and how the banking industry is reacting to this?
So we're still waiting for the finalization, but I think the surprising things were, one, that he went down to the 100 billion market cap. Not market cap, but asset size. And then also, you know, he was saying basically adding, you know, it would add like 2 percentage points, $2 for every 100 billion in risk-weighted assets. So, or $2 for every $100. I can't get away from saying the wrong thing here. But anyway, the bottom line is, can we just get the final rules? The banks have been waiting for these for a long time. And so I think that's why maybe you didn't see much movement in the stocks yesterday, because, you know, Powell had already hinted at sort of a 20% increase in capital required. Now we have this other hint. So we're still waiting to get the proposal. The other thing that we got, which is sort of old news now, but we did get the stress tests. The banks all did well except for Citi. And so that signaled their requirements are coming down. So that's a key positive. But banks are staying conservative, partly because of the Basel III endgame, and then, you know, partly because of the economy.
So why are some of these new, I guess, rules for the banks, is this a response to some of those smaller banks stressed a few months ago?
So I think maybe the you know, dipping down to the applying the rules to a broader set of banks, I think it definitely comes to that.
But it seems to me there's already a lot of rules for the banks. Maybe I'm just paraphrasing Jamie Dimon here, but they just weren't enforced efficiently at all for some of these banks. It wasn't like there's not enough rules there, so that the existing rules were not efficiently enforced properly.
Well, and part of it is, right, that, you know, the rules are always, you know, solving the last crisis.
Yes.
So one thing that we we know that happened since the global financial crisis is just the fact that the mortgage market has been tight, and so like that's the one area we don't even worry about this time around, the residential mortgage. We do worry about commercial mortgage, but it hasn't been a while since we've had to worry about that.
So Michael Barr basically saying that America's biggest banks are going to need more capital, but what about when it comes to these regional banks, to Paul's point, that obviously were under those stresses during the spring, and what does that mean moving forward for some of these mid-sized or smaller banks?
And that's why, to Paul's point, I think that's why we did get some regulations reaching out to these, super regional and big regional banks, right? So it's not the smaller community banks, but some of those regulations in recent years under Quarles had actually been rolled back. And so I think sort of bringing them back into the fray is part of the issue. But I would say, the key issue that sort of brought down those three banks, it was asset liability management, but it was a broad issue that happened across the banking sector where you had this huge inflow of deposits that was invested in securities, then rates went the other way, right? That's what caused, or was the catalyst for these three banks that, as I said, the asset liability management was part of it, right? Because what you saw for banks that managed it well was to say, look, we know these deposits aren't permanent. We're not going to tie them up in something that's going to potentially make us illiquid.
All right, so we're going to have some big banks reporting on Friday, which means we'll probably see you again. J.P. Morgan, Wells Fargo,
Citigroup.
And Citigroup. So three of the biggies. What are we looking for here? I can't imagine the capital markets business has been anything to write home about. What are you really going to be looking at for these earnings?
It's not, and I think like there's definitely a dichotomy in terms of the trading and fees. So I guess, if you just look at it sort of a one-quarter view, you'll see everything down. But trading is really normalizing into a historically high level. So if you look at a very long-term chart, yes, trading is coming down a bit, but we're normalizing at a historically high level. Fees, on the other hand, are steadying in levels closer to pre-pandemic, so very low levels.
Mm-hmm.
So one of the big things we're going to see this quarter are higher expenses tied to severance. And we're going to see, banks finally, I think, coming to terms with the fact that, okay, this huge boom that we saw in 2021 is not likely to repeat anytime soon. And we are hearing banks, talk about some signs of life at the end of the second quarter, some pickup in activity. But, if you follow the money, the headcount cuts, and as I said, a lot of the severance charges, I think that, banks are sort of recognizing that, we are going to be setting at these lower levels.
What do you think net interest margins will tell us? Obviously, that's a key gauge when you're thinking about the profitability indicator when it comes to a lot of these big banks.
So I think, my view is perhaps different than some of the other analysts that you've heard out there. Maybe it's just because of the banks that I'm looking at. But for banks like J.P. Morgan and Citigroup that have big credit card portfolios, we think that their margin could, and their net interest income actually could be a little bit more resilient versus the other banks where commercial and industrial loans, so that's sort of the bread and butter of the commercial banks. Bank of America is also a relatively bigger player in that market. Those loans are actually shrinking, coming in a little bit softer than expected. Bank of America talked about some of their utilization rates, things stabilizing. They had thought things were going to get a little bit better there, but they're not. And so I think for those banks, you could get net interest income a little bit softer than expected. But I would keep in mind that the net interest income numbers, we are at a hugely robust level. It's just that investors are looking at, stocks are discounting mechanisms.
Mm-hmm.
We look forward. And, the question is, how far do we start going down from here?
All right, so 30 seconds here. What do you expect Jamie Dimon to say? Or is that too hard to predict?
You know what? If I'm going to guess, he's going to talk about the regulations and really, like, when you look at what's happening with these capital requirements, it's a little bit crazy. This is a key